Yeah, so I think trade flows are the real goods exchange that we do, right? And if you think about this over a period of time, as the Indian economy has actually grown, has become more sort of consumption oriented, more production getting done domestically, we have needed to import certain items which we don't produce domestically, and one of those items is crude oil. Right. Energy needs for the country has grown.
Right.
And we don't produce enough crude domestically, so we've had to import crude oil. And crude oil today becomes the largest component of what we call as our import basket.
Right.
Right. Then there are a few other things. For example, we also need to import certain equipment which we don't produce locally. Simple example is smartphones.
Right.
Electronic items. This is another very large component of our imports from rest of the world.
Third one is gold, I think.
Of course, I was coming to that. So the third commodity in some senses in terms of value and that we Indians consume a lot is gold.
Yeah.
And we don't produce enough of it domestically, right? So we have to import that. So these are some of the large items that we import. There are obviously a whole bunch of items that we import. In terms of our exports, obviously historically we have been known for our exports of software.
Right.
I think since I would say mid-90s, over the last about 30 odd years, our software export industry has grown significantly. So that's a large component of export. But what has also happened, and this is something which many people may not know, that over a period of time, we have started importing a lot of items and added value to them and produced something else and then exported that.
Right.
Two examples. One is gems and jewelry.
Right.
So we import a lot of raw diamonds, rough cut diamonds. We sort of polish them, we create jewelry out of them, and then we export it. Right? That's one example where we import for the purpose of export. The second commodity where we have actually started to do a lot of exports is crude oil itself.
Right.
So today we are actually refining crude oil and then selling outside the refined products, right? So in some senses, the whole contours of, as our integration of our economy with the rest of the world has increased, the contours of what goes into our import basket and what goes into our export basket has actually substantially changed over a period of time. And both imports and exports have grown cumulatively substantially over a period of time. So today, I mean, if you look at it, the total value of imports and exports is almost $1.3 trillion. That's the amount of goods and services we are importing and exporting.
Right.
That's the real economy part of it. Then we come to the financial economy part of it, the financial side of it. Obviously, outsiders are investing in India and they are basically bringing in dollars to make that investments. Whether they are investing in the companies or they are investing in debt products, there is an external investment that is coming into India. So that's what we call as capital flows.
Right.
And there is a reverse capital flow as well, in the sense that Indians are also investing abroad. And the third component, which is very, very important for us as a country, is remittances.
Right.
You know, one of our biggest export is people, human capital, right? And when people go outside, they take citizenship of other countries, they work for other countries. Whatever savings they have, they actually send it back to the country. Remittances, therefore, are an extremely important part of our, sort of cross-border flows that affect the currency markets in a big way. As I mentioned, that the demand and supply is the ultimate determinant of a value of a currency, and the best way to think of demand and supply is in terms of three components. The first component is what we call as current account. Current account is goods and services that we export and import for the purpose of present consumption. Right? And India has traditionally run a current account deficit, which basically means that we are net importing more as compared to exporting. Right? The second component of this is what is called the capital account. Capital account is the investment and financial related activity, whether it is in the form of debt, equity, or any other form. And net, we are net importers of capital, which means that more money comes into India, right, as capital flows than what we send out. And in some senses, our deficit on current account gets balanced by the money flows by way of current account.
Capital account.
The capital account. And the difference between the two is what we call as balance of payments balance. Right? External deficit or surplus. So while we are current account deficit, we actually get more inflows in the capital account, and hence in general we are balance of payment surplus. Right. So that's the broad equation as far as the what we call as the external account between India and rest of the world.
Neeraj, how has this moved? Like the current account, we've always been a current account deficit country, but how has this moved over, let's say, the last 10-15 years? Has the deficit narrowed? Has it broadened? And same on the capital account side, kind of how has that, the nature of that changed?
So it's a very, it's not a very consistent story over a period of time. We used to run a fairly high current account deficit, for example, in 2012, say about 10 years ago, right? Say our current account deficit at one point was almost $80 billion. Over a period of time, that current account deficit has narrowed, but we have had current account deficit move in a very narrow range of say 2 to 3% of GDP. So for example, I would say broadly 1 to 3% of GDP is the range within which our current account deficit has moved. On the flip side, because we are importing capital, because outsiders are investing in the country, we have been a capital surplus. In that sense, capital has been coming into the country, and that number again has varied over a period of time depending upon multiple factors, including attractiveness of India as an investment destination. In general, our capital flows have been higher, and our balance of payment surplus has been about say 30 to 50 to sometimes even 70-80 billion dollars net surplus.